In this video, we'll be focusing on indirect tax. An indirect tax is a tax imposed by the government on the production or consumption of goods and services, where the tax is paid by firms to the government but passed on to consumers in the form of higher prices. Common examples of indirect taxes include VAT, excise duties on alcohol, tobacco, and fuel, and environmental taxes such as carbon emission tax. Indirect taxes are different from direct taxes because they're linked to spending rather than income and profit. Governments impose indirect taxes for several key reasons. First, indirect taxes raise government revenue, which can then be used to fund public services such as healthcare, education, and infrastructure. Second, indirect taxes are often used to discourage consumption of demerit goods, such as cigarettes or alcohol, which generate negative externalities like healthcare costs. Third, indirect taxes can be used to internalize negative externalities, for example, through fuel duties or carbon taxes, by making consumers and producers face the social cost of their consumption and production. Finally, indirect taxes may be used to change behavior, for example, reducing congestion or pollution. Now, let us analyze an indirect tax using a demand and supply diagram. The original market equilibrium occurs when demand intersects the supply at the equilibrium E1, where the market equilibrium price is P1 and the transaction quantity is Q1. Now suppose the government imposes a specific indirect tax, meaning a fixed amount per unit, for example, £1 per unit. An indirect tax raises the firm's cost of production for every unit produced. Now, firms are only willing to supply the same quantity at a higher price. The supply curve will shift vertically upwards by the full amount of the tax, that is £1 in this example. It is very important to know that the supply curve will shift upwards, not leftwards, because the tax changes production costs and not the production capacity. The supply curve after tax is labeled as S prime, and it is parallel to the original supply curve S. The vertical distance between the two supply curves is exactly equal to the tax per unit at all levels of output. The tax creates a new market equilibrium at E2, where the transaction quantity is Q2, lower than the previous original transaction quantity, and the price consumers pay is now P2, which is higher than the original price P1. This higher price reflects the fact that part of the tax burden is passed on to consumers. Now, let us draw a dotted line vertically from the new equilibrium E2 to the original supply curve. At this price, P2 minus T, it is the price received by producers after the tax. The key point here is that the vertical distance between P2, the price paid by consumers, and P2 minus T, the price that producers receive, equals exactly the size of the per unit tax. We say that the tax creates a wedge between the price consumers pay and the price producers receive. The rising price consumers pay from P1 to P2 occurs because firms pass on some tax burdens to consumers. The fall in quantity occurs because the higher price contracts demand. This demonstrates that indirect taxes reduce consumption, which is particularly important when taxing demerit goods or goods associated with negative externalities. Government tax revenue from the indirect tax can be calculated as the tax per unit T multiplied by the after-tax transaction quantity Q2. This area here can be represented as B plus D, the rectangular area that I just highlighted. Before the tax, consumer surplus is the area under the demand curve and above P1 up to Q1. So area A plus B plus C. After the tax, consumer surplus falls to the area under the demand curve, above the price they pay, P2, up to Q2, so area A. This loss of consumer surplus by area B plus C occurs because consumers now pay a higher price and consume fewer quantities. Producer surplus also falls. Before the tax, producer surplus is the area that is above the supply curve and below the price P1, bounded by the transaction quantity Q1, so area D plus E plus F. After the tax, producer surplus become the area that is above the supply curve, but below P2 minus T, bounded by the after-tax transaction quantity Q2, so area F. The loss of area D plus E is because the producers is now selling fewer quantities and receiving a lower price. We say that both consumers and producers are worse off due to the indirect tax. And economic welfare is the sum of consumer surplus, producer surplus, and government revenue. Although government revenue increases, the total loss in consumer and producer surplus is greater than the tax revenue gained. This creates a deadweight loss, which can be represented as area C and E. The deadweight loss represents a net loss of economic welfare, and it occurs because some mutually beneficial trades no longer take place due to the indirect tax.